Hi everyone, my name is Kofeng. Welcome to the webinar on Singapore tax on the topic of individual tax. I will be your lecturer for today's webinar. Before I start the webinar proper, allow me a minute to introduce myself. I'm a tax professional with more than 18 years of tax experience, specializing in international taxation. I have been teaching ATTS M4 as well as the Singapore Foundation program for more than 10 years. In addition, I'm currently serving as an in-house role in a US MNC, looking after the APAC operations. Without further ado, let us start the webinar proper. Before we go through the webinar, it will be good to look at the learning objectives. The learning objectives should serve as a signpost to assist you in your revision, as well as to understand what is the focus of this topic. So the learning objectives for today are as follows. 1. Explain the scope of individual income tax for residents and non-residents. Explain the various types of income, liabilities, and personal reliefs. How to compute an individual income tax liability, taking into account of personal reliefs. Illustrate the tax computation for individual tax. Illustration of tax computation format for non-resident individuals deriving Singapore source employment income, as well as other Singapore sourced income. Why is tax residency important? Before we start, you need to understand that the only reason why tax residency is important for the purpose of the module is that it will affect whether or not you are subject to a flat rate or a progressive tax rate. In addition, certain reliefs are only available to tax residents of Singapore. Therefore, it is important to understand how and what other ways that one can determine tax residency of either an individual or a company. The tax residence of a taxpayer, be it individual or company, is important as it will determine how and whether the income of the taxpayer will be taxed. This also helps to determine the tax rate relief and other tax benefits if applicable. Determining the tax residency of an individual can be done using the qualitative or quantitative tests. Now, residents in Singapore. Under the Singapore Income Tax Act, the definition of resident in Singapore includes an individual who is A, physically present in Singapore, or B, employed in Singapore other than as a director for 183 days or more. The 183 days or more refer to the total number of days an individual is in Singapore during the relevant basis period. For example, the basis period of YA 2021 is 1st January 2020 to 31st December 2020. Essentially, for an individual purposes, their basis period will always be the calendar year end. Now, the expression resident in Singapore is defined in Section 2 of the Singapore Income Tax Act and is set out as follows. An individual means a person who, in the year preceding the year of assessment, resides in Singapore except for such temporary absences therefrom as may be reasonable and is not inconsistent with a claim by such person to be resident in Singapore. It includes a person who is physically present or exercises an employment other than as a director of a company in Singapore for 183 days or more during the year preceding the year of assessment. In relation to a company or body of persons, means a company or body of persons control and management of the business is exercised in Singapore. For the purpose of this webinar, as we are focusing on individual income tax, we will examine in greater details the determination of tax residency from an individual standpoint. While the above definition extracted from the Singapore Income Tax Act can be a mouthful, there are other practical ways to determine the tax residency. Singaporean can choose to be assessed as a resident if he exercises employment outside of Singapore for more than 6 months in a calendar year. Similarly, if an individual is physically present or employed in Singapore for at least 183 days for a continuous period over 2 years, he or she will also be regarded as a Singapore tax resident. Regardless of the period of presence, an individual can also be considered a tax resident if he stays in Singapore for 3 or more consecutive years of assessment. Food for thought. Why would an individual, such as a Singaporean, would like to be deemed as a non-resident for tax purposes? This is because in other countries such as the US, they do have a global income tax regime. Therefore, an individual who is exercising an employment in the US may be able to claim certain deduction or benefit if he or she chooses to have his tax residency being deemed as one of being in Singapore. However, as that is a complex area that requires knowledge in international and cross-border taxation, it will not be part of the scope of your current topic. Next, by the operation of the law, any individual who does not meet the criteria, which I explained earlier, would be deemed as a non-resident. Generally, an individual will be considered as a non-resident if he or she does not have a permanent residence in Singapore and has not been physically in Singapore for more than 183 days within a calendar year. So examples will be the professional aspects as well as a migrant worker who could have come to Singapore for work reasons. They would need to be subject to the physical presence test as well as 2 other concessionary measures that I would like to talk about later. But ordinarily, you can presume that a foreigner who does not spend sufficient time or does not meet the prescribed criteria of the concessionary treatments, they will not be considered as a tax resident for Singapore income tax purposes. So I will now move on to cover the first test, known as the qualitative test. So this is the test on the residence, and based on the qualitative test, an individual is resident in Singapore during the 12 months immediately preceding the year of assessment if he or she only have temporary absences from Singapore, which can be disregarded if the absence from Singapore is substantiated and reasonable. So, what can we infer out of this qualitative test? Any Singaporean would ordinarily be deemed to be a Singapore tax resident because its place of permanent abode is considered to be in Singapore with all their family connections. This will remain true even if in a particular year, for personal reasons, the individual may remain outside of Singapore for a significant period of time, such as pursuing his higher degree or qualification, or outside of Singapore to visit extended family members. These are temporary absences which can be accepted and justified in front of the Inland Revenue. Now, the quantitative test will be something that is more scientific and can be determined. It is based on the period of physical presence in Singapore or employment exercise in Singapore, other than in the capacity of the director of a company. You may wish to note that the director here refers to the legal director of a company that is recorded in Accra. Now, typically, qualitative tests would be something that we want to talk about in terms of the reasons for absences. So let's look at one particular example on how it could be applied. Mr. Korn, a Singapore citizen, was seconded by his company to overseas to work for a related company for the year 2021. At the end of the secondment, he returned to Singapore and continues working with the Singapore office. State the resident status of Mr. Korn for YA 2022. One notable fact about this question is that the question did not provide further details on how long he was away in 2021. It could be a week, a month, 6 months, or 9 months. However, as you look at the suggested solution, you will realize that ordinarily, we will still regard Mr. Korn as a Singapore tax resident for YA 2022. And our basis is grounded on the fact that, one, he's a Singapore citizen, ordinarily resides in Singapore with familial ties in Singapore, and his absence is temporary and can be explained. So in this case, you may further point out the fact that he was posted to work overseas by his company, but his employment with the Singapore company did not cease. He returned to his post after the end of the secondment. As such, while we do not know how long he was seconded for and the number of days he was away from Singapore, under the qualitative resident test, we can come to a reasonable conclusion that his absence from Singapore is temporary for a justified reason, such as work, and he will be expected to return to Singapore. Therefore, overall, we can conclude that Mr. Korn will be treated as a Singapore tax resident for YA 2022. Food for thought. If the question is amended such that Mr. Korn is a non-Singapore citizen, would the same analysis apply? My view here is, while we may still reasonably come to this conclusion, we may not only rely on just the qualitative resident test, we will need to look into more facts, or rather, the question will need to be providing more facts for us to make a more accurate determination. Now, let's move on to the next example to understand the concept better. Alice, a Malaysian, was employed to work in Singapore for the period of 15 March 2022 to 31st July 2023. She tends to make several business trips due to the nature of her work. She was only present in Singapore for 150 days. And I think you can safely assume the 150 days is during the period stated above from 15 March of 2022 to 31st July 2023. So the question that is being asked here is Alice a tax resident of Singapore for income tax purposes in the year of assessment 2023? Now, the suggested solution, we analyzed two factors as mentioned previously. One, the number of days physically present in Singapore. Two, the number of days of employment exercised in Singapore. As you can see, Alice did not meet the 180-day 3-day rule based on her physical presence in Singapore. However, she does satisfy the 180 days rule based on the period of her employment. Therefore, for YA 2023, Alice is likely to be treated as a tax resident of Singapore. So below is the working to explain how we came up with the assessment itself. Next, administrative concessions. So just for background and context, while administrative concessions are not law, they represent a method that's prescribed by the IRAS in the form of an IRAS circular to provide better clarity, or in a lot of times, the practical approach to determining certain complex tax rules. In this case, the IRAS provided administrative concession known as the 3-year administrative concession and 2-year administrative concession respectively for determination of tax residency of individuals. This is because many individuals may face difficulty understanding both the qualitative and quantitative rule, and at times the quantitative rule may not be practical, especially when someone starts employment late in the year but intends to be employed in Singapore over a long period. So for example, the 3-year administrative concession covers a situation where a non-Singaporean, i.e. a foreign individual, other than one that's employed as a company's director, who is physically present or exercise employment in Singapore for at least 3 consecutive YA, will be regarded as a tax resident for all the YAs, even though he may be physically present in Singapore for less than 183 days in the first and last YA. This administrative concession is very commonly found to be used by expatriates. As mentioned, company hire individuals at the timing that they need for commercial purposes. It is not practical to expect the company to start employment at the start of the calendar year so that their expatriates or their employees who are not Singaporean would satisfy the 183 days requirement for exercising employment or being physically present in Singapore. So in this case itself, even though the first and the last YA from the physical number of days in Singapore, the individual may not satisfy the 183 days criteria, the administrative concession allows the individual to be treated as a Singapore tax resident as long as he has continuously exercised employment or presence in Singapore for 3 consecutive YA. Under the 2-year administrative concession, A foreigner who is physically present or exercise employment in Singapore for a continuous period of at least 183 days over a 2-year period would be considered a tax resident for both years. So again, this concession is granted to cover situation where the employment of the foreigner unfortunately straddle through 2 years, and the fact is that the company intends to hire the individual for longer term. Therefore, this is more a benefit to the individual. As we go through, you will realize that based on strictly just the individual income tax rate and subject to the level of income, there may be situations where an individual will pay lesser tax as a Singapore tax resident as compared to a non-resident. On this slide, we would like to present the 2-year administrative concession as well as 3-year administrative concession diagrammatically for your ease of reference and understanding. Starting with the 2-year concessional rule, where employment period straddled across 2 years, you will see that as an example, in year 1, the individual was hired for 100 days, and year 2, hired for another 100 days. If we strictly look on a year-on-year basis, the individual does not satisfy the 183 days requirement. However, the 2-year concessional rule or the administrative concession allow us to look at both of the period, and as long as the period that straddle across the 2 years is at least 183 days, we will be able to treat the individual as tax resident. Now, the 3-year concessional rule is also something that is intended to be beneficial to these individuals. As you can see, an expatriate might be hired in Singapore for contract work or a limited amount of time. So using the diagram as an example, in year 1, the individual exercise employment for 100 days, fully employed during the 2nd year, and departed the company or left the role for after 10 days in year 3. Ordinarily, should we look at the years on an independent basis, the individual would only qualify as a tax resident for year 2, because that's where he has continuously exercised employment for at least 183 days, putting aside whether or not he was physically in Singapore for the same period. However, the 3-year concessional rule allows the individual to be treated as a Singapore tax resident not only for the 2nd year, but also for the 1st and 3rd year, where the individual spends significantly less time being employed in Singapore. Now we move on to the next concept, partnership. Partnership will be covered under a separate webinar on its own, known as taxation of partnership. However, you need to be aware that a partnership could involve individual income tax computation when the individual is one of the partner of a partnership. So for this module, what you need to understand is for partnership, the accounting year end will be taken as the basis period. So for example, if the partnership's year end is 30th June, then the YA 2024 basis period for the partnership would be 1st July 2022 to 30th June 2023. In addition, for sole proprietor and employment income, generally, the individual will report those income based on a calendar year and between 1st January to December 31st of every year. For sole proprietor, there is an exception where the sole proprietor can elect to have his income being taxed based on the accounting year end of his sole proprietorship. Income derived by an individual in Singapore is taxable in Singapore regardless of the place of payment. It is taxable based on the period each which the income relates to. So, for example, if a US citizen employed in Singapore for the whole year in financial year 2023, its income would be subject to tax in Singapore, regardless of whether the individual is paid in his Singapore bank account or its US bank account. Next, what are the general type of income that an individual could derive and is being taxed in Singapore? So typically, individual can earn the following types of income and are taxable. For instance, employment income, taxable under Section 10(1)(b) of Income Tax Act. Dividends and interest, covered under Section 10(1)(d) of the Income Tax Act. Pension, charge, or annuity, covered under Section 10(1)(e) of the Income Tax Act. Rent, royalties, premiums, and any other profits arising from property covered under Section 10(1)(f) of the Singapore Income Tax Act. You may need to note that while these categories are prescriptive, all income of revenue nature derived by an individual should be taxable unless otherwise exempted. So, in relation to your employment income, which is also the main source of income for a majority of us in Singapore, the basic rules are as follows. Employment income is taxed based on the period in which the income is earned. The basis period for employment income is usually the calendar year, January 1 to December 31st of each year. The timing of payment and the place of payment is irrelevant when determining the taxability of the income to the individual. Employment income is sourced depending on the place where the services are rendered. My interpretation of this would be look at the country where the employment is exercised. For example, if a Singaporean or a foreigner is exercising an employment in Singapore, generally we will say that the employment income is sourced in Singapore. Of course, in terms of the income that is derived by an individual, there are also income that is tax exempt. So some examples of income earned by individual which are tax exempt and not taxable, they are income derived outside of Singapore and remitted to Singapore by an individual. So one good example would be if you found a job in Dubai, exercise an employment there, subsequently you bring all the employment income you earned in Dubai into Singapore, it is not subject to tax. Next, receipt from insurance policy or investment is also exempt from tax. One notable call out is whether or not if you receive a payout under key man insurance, whether that would be taxable. Next, profit from sale of property. Now, a lot of Singaporeans make their first bucket by selling HDB flats or private property. Generally, sale of property is not taxable as it is considered to be capital gains. Singapore currently does not have a capital gains regime. While it is out of scope of this topic, you may wish to know that whether or not a gain is capital or revenue in nature is determined by a concept known as 6 badges of trade. You will learn more about this in the other modules. Lastly, deposit interest from approved bank and licensed finance company is exempt from tax for an individual. However, you need to remember that any other form of interest, such as informal loan to friends or relatives, or interest derived from pawn shop, will still remain taxable. Also, deposit interest from bank, approved or otherwise, will also be taxable in the hands of a company. This exemption only applies to individuals and from approved bank and licensed financial institution. Next, Section 13 exemption. Section 13 exemption covers a situation for non-resident. So, typically, without the exemption, non-residents' employment income will be taxable in Singapore from day one. However, Section 13 exemption states that income derived from employment exercised in Singapore for not more than 60 days by a non-resident individual in Singapore is not taxable. Note, this excludes directors and public entertainers whose income will be calculated separately. So what does it mean for a non-resident individual? Using back to my example, if a US citizen comes to Singapore, enters into a 45 days employment contract with a Singapore company, he would not be required to pay tax in Singapore if that is the only income he derives during the calendar year. This is because his period of employment exercised in Singapore did not exceed 60 days. For non-resident director, they are taxed based on the payment made to them. So it is collected or imposed on them by way of withholding, and with effect from Jan 1st, 2023, the withholding tax rate is 24%. For non-resident public entertainers, they will be subject to a 15% withholding tax, an increase from 10%. However, for non-resident public entertainer, their income may be exempt from tax in Singapore if the visit is substantially funded, i.e. more than 50% by the government of the non-resident public entertainer's home country. Lastly, what are the common income received by an individual is exempt? Dividend income is exempt from tax in Singapore. Also, withdrawal from CPF is exempt from tax. This means that all your parents would have reached the age to withdraw their CPF, would not be expected to pay tax on their CPF amount that's in payouts received. So, what about the individual tax rate? For tax resident, the individual is subject to a tiered rate depending on how much income and which income bracket he or she is in. For non-resident, they will be subject to the higher of either the tax computed under the residential tax, Singapore tax residential rate, or 15%. This is where the tax residency plays a part. So, why do I say so? This is because if you are a Singapore tax resident, for example, the first 20,000 of your income is considered tax exempt. The same exemption is not applied to a non-resident. Therefore, a flat rate of 15% will be applicable. So just comparing the amount of tax an individual will need to pay if he's a Singapore tax resident versus a situation he is not. For the first 20,000 of income, a non-resident will have to pay 3,000 of tax, whereas a Singapore tax resident will not be paying any tax. Next, we come to the personal relief section. So in this slide, we see the reliefs that's available to the individuals subject to conditions. So what are the reliefs then? A, earned income relief. B, spouse relief. C, handicapped sibling relief. D, child reliefs. E, foreign maid levy relief. F, grandparent caregiver relief. G, parent relief. H, Central Provident Fund CPF contribution reliefs. I, life insurance relief. J, course fee relief. K, National Servicemen NSmen reliefs. And L, Supplementary Retirement Scheme SRS contributions relief. So in terms of what you should know for personal reliefs, I will recommend candidates to be very strategic. It will not be beneficial to you if you memorize information that will be provided to you during the upcoming exam. Generally, release information will be made available in Appendix A. Looking at the Appendix A for the past paper, the latest one being 2023, the following information was provided. A list of the individual income tax reliefs, such as earned income relief, other reliefs, NSmen relief, personal income tax rate, withholding tax rate, goods and services tax rate. So familiarize yourself with Appendix A before the exam as you attempt the questions. This will give you a good gauge on what are the information that you need to memorize before the exam. So what are some of the information that you do not find in Appendix A? In general, I will summarize it to be, do not expect the conditions to be set up in detail in Appendix A. If it does come out, it's considered a bonus. Most of the time, they may not include it as it will be too detailed. So for example, the spouse, child, parent, and grandparent relief, there is a condition that these individuals whom you are claiming a relief of does not earn more than 4,000 income per year, which may vary if they are handicapped. Next, handicapped sibling relief. If you're living with the claimant or at least incur 2,000 in maintaining that individual, these are the conditions that you need to be aware of. For example, insurance relief, it's not available if your CPF contribution or your CPF relief claim exceed 5,000. Otherwise, you will be granted a relief based on the delta between 5,000 and the amount of CPF relief you're claiming. CPF cash top-up relief, including medical account relief, is actual allowable amount top-up up to a maximum of 16,000, 8,000 for individual, and 8,000 for your family members, such as your parents. Grandparents caregiver relief for working mom only, grandparents or parents not working live in Singapore with a child 12 years old or below. Foreign maid levy relief is only available for women. In addition, the total allowable relief in NUIA is capped at 80,000. Parenthood tax rebate, which is not really a relief, it's more of a credit, is as follows. You'll get 5,000 for the first child, 10,000 for the second child, and 20,000 per child from the third child onwards. So, in addition, for the parenthood tax rebate, you need to satisfy additional conditions. So, you must be married Singapore tax resident, who, including divorcee and widowed individual, who has a legitimate child. So, what is defined as a legitimate child is it is born to your family on or after 1st January 2008 and becomes a Singapore citizen at the time of birth or within 12 months thereafter. For illegitimate child, which is child born based on the year of marriage, is born on or after 1st January 2008 and whose birth occurs before the marriage of the natural parents and whose natural parents become lawfully married before he reaches 6 years old, and the child is a Singapore citizen at the time of marriage of his natural parents or within 12 months thereafter. For adopted child, those will only apply if they are legally adopted on or after 1st January 2008, but before the child reaches 6 years old, and becomes a Singapore citizen at the time of legal adoption or within 12 months thereafter. Next, we'll move on to cover how a sample recommended individual tax computation would look like. Please note that this is a suggested format, and a format can also be found on the Inland Revenue's website. The key takeaway you should get out of this is that you need to detail each and every source of your income for examination purposes. So, for example, if an individual has an income from his employment and also derives an income from his investment, such as dividend income, or perhaps business income from his partnership involvement, all this must be set out clearly rather than having one line to say taxable income. In this case, here are some of the suggested types of income that you should break down in your tax computation: salary, bonus, allowances, hotel accommodation or housing accommodation if you are granted one by your employer, other employment benefits that would make up your total employment income, adding your other source of income. In this example, is royalty income. If you receive rental income, there will be another line before going to your statutory income. And from statutory income, you will be deducting your usual losses brought forward, or the donations brought forward if applicable, and then reaching your assessable income. For individuals who only derive employment income, generally your statutory income would be your assessable income unless there are unutilized donation or losses brought forward from your earlier YAs. So after assessable income is where we will look at the various reliefs. Some of the reliefs are listed here. And please note that for each relief, for exam purposes, you will need to analyze and provide commentary on how is it applicable, how did you derive the answer. One thing to note, all reliefs must be kept at 80,000 in total. So in a situation where an individual's relief exceeds 80,000, it will be capped at 80,000. From then on, you will work out your chargeable income. And one notable point here is you can see the parenthood tax rebate is applied against the tax payable. As mentioned, that is not strictly a relief, more of a tax credit. All right, now I will move on to a work example to give you a little bit more practical guidance on how to deal with an exam question. This question is extracted from Singapore Tax June 2022 paper. Sandra Lim, a 54-year-old Singaporean, worked for KTV Medical Supplies Private Limited, KTV, as their senior sales manager until 30th September 2021. Sandra tendered her resignation on 1st August 2021 as she decided to focus on the business she had started with her partner in December 2020. The general partnership business had won a major contract to act as the sole distributor of medical devices manufactured by a company in Oberhausen, Germany. They anticipate an increase in business in the financial year 2022. For the period up to 30th September 2021, Sandra derived the following income and benefits from her employment with KTV. Salary at $15,000 a month, $135,000 for the period. Entertainment allowance of $1,500 a month, $13,500 for the period. 4 months discretionary performance bonus for the employment year 2020 received in Feb 2021. Sandra was provided with the use of a company car purchased in July 2017 at the cost of $183,000. The preferential additional registration fee, half rebate, is $50,000. The car was returned to KTV at the end of her last day of work. For the employment year 2021, KTV incurred $8,400 on road tax, insurance, and maintenance expenses on the car. All other running expenses were borne by Sandra. There are 365 days in year 2021. The latest model of Samsung Z Fold 3, costing $2,500, was purchased for Sandra's use in June 2021. The company decided to let her keep the phone after her last day of work. Sandra incurred the following expenses in respect of her employment with KTV. Business entertainment expenses of $2,400, petrol and parking charges of $2,800 spent on company car for business-related travels, chauffeur hire car charges of $240 for business-related travels. Sandra is required to serve 3-month notice period under her terms of employment. However, as she is required to commence travel in October for her partnership business, KTV is agreeable to release her from employment earlier than scheduled, but Sandra will have to compensate KTV 1 month salary of $15,000 in lieu of her completing her notice period in full. The next portion will be information with respect to her partnership. Sandra's partnership business was registered and commenced operations in December 2020. For the first financial period ended 31 October 2021, Sandra's share of the visible loss was $55,000 after taking into account the following. Salary for the October 2021 of $1,500, private motorcar expenses of $6,800, of which $5,400 was incurred for non-business travels, and overseas travel expenses of $14,700, of which $9,600 relates to expenses incurred on family members who joined Sandra in her business trip to meet the German principal. Sandra's share of interest income derived through the partnership is $1,300. The interest income was earned on loan given to staff. Other information of Sandra are as follows. Sandra is a widow with 2 children who are Singapore citizens. Her firstborn, 23-year-old Jennifer, graduated from university in June 2021. She started working as a trainee with OCBC Bank under the SG United Traineeship Program on November 1st, 2021. Her monthly allowance is $1,800. Her second child is 21-year-old Gerald, who completed national service in March 2021. He commenced tertiary education at the local university in July 2021. His NS allowance for the year 2021 is $3,150. Sandra is currently living with her parents, Samuel and Patricia Tan, who are in their late 70s. Samuel derived dividend income of $25,000 from investments in Singapore shares during the year. Patricia won $15,000 in total winnings. Sandra continues to support her mother-in-law by contributing $2,000 monthly towards her nursing home expenses. Sandra has hired a foreign domestic worker to help with household chores. The foreign maid levy incurred for the year 2021 is $720. First question. computes Sandra's minimum tax payable for YA 2022 and maximize claims for reliefs available to Sandra. All relevant reliefs available to Sandra should be considered and included in your answer. With respect to the following reliefs, Working Mother Child Relief provides your working showing the rate claim applied to each child, if any. Parent relief indicate on which parent or parent-in-law the relief is claimed. In attending this question, it is important you ensure that the two specific points are either addressed directly in your question, like how the sample solution looks like, or in a separate paragraph. There is no restriction to how you can explain those 2 points, as long as those 2 points are adequately covered. Now, going through the answers, we can see that first we start with her employment income. We set out her basic salary, bonuses, entertainment allowances, motor car benefit calculation, mobile phone. So one notable call is, why do we include mobile phone amongst others? If you look back at the question, you will notice that Sandra was allowed to keep the phone post her employment. Therefore, it is considered her employment benefit. It would not be included if Sandra returned the phone to KTV after her employment ends. That will give us her total employment income of 218,873, deducting expenses she has to incur for her work, such as entertainment expenses, software hire car charges, giving us a net employment income of 216,233. Next will be her partnership business. Again, partnership related calculations are disclosed separately, as it is a different income source stream for Sandra. Starting from the divisible loss of 55,000, we add salary of 1,500, motor car expenses that are not business related, overseas travel expenses that are not business related, leading to an adjusted net loss of 38,500. In total, her earned income will be 177,733. Do not forget the 1,300 interest income that she received. Why is this interest income taxable? If you look at the question, it is earned by Sandra in relation to loan given to staffs, and therefore not considered to be exempt interest income. We will then reach a statutory assessable income of $179,033, and we will start to deduct all the relief. As you can see, for both Jennifer and Gerald, they will qualify for the Working Mother Child Relief, as they do not derive income of more than 4,000. So she would then get the relevant percentage computed. It is required to be disclosed as part of the question. In addition, parent relief for mother and mother-in-law are also separately disclosed. One thing to note is that Sandra's father was not included, as he derived investment income exceeding the threshold. Next, you will also notice that the total relief that Sandra was entitled to is 108,297. As it exceeded the 80,000 threshold, we need to cap at 80,000. And thereafter, you should be able to compute the tax for Sandra on the basis that she is a tax resident. Next, Sandra has hired Clifford Ong, an American citizen, to work in her business with effect from 1st November 2021 on a 2-year employment contract. Using the relevance test of residence and administrative concession, explain Clifford's tax resident status for YA 2022. So in this case, what are the fact patterns we need to address? We need to, 1, explain the residency of Clifford using the test of residence, also bring in the administrative concession. So looking at the suggested solution, Clifford does not qualify as a tax resident for YA 2022 under the quantitative test, as he was not physically present nor exercising employment in Singapore for at least 183 days or living or working for less than 183 days in calendar year 2021. Now, assuming that Clifford wasn't in Singapore until he was hired, he is only physically in Singapore between 1st November 2021 to December 31st, 2021. Therefore, under the quantitative test, Clifford would not qualify. In addition, under the qualitative test, which is not mentioned here, but I also recommend you can cover briefly that given Clifford is an American citizen, ordinarily, he will also not be qualified as a Singapore tax resident under the qualitative approach. Thereafter, we need to look at the available administrative concession. So that's where the answer move on to say, however, as he will be exercising employment in Singapore over 3 continuous years, he will be treated as a tax resident for YA 2022 to YA 2024 under the 3-year administrative concession. How do we come up with the fact that it's going to be 3 continuous years when he's on the 2-year employment contract? So this is where I say you need to draw a timeline and it's straddled across 3 years. So given that he will start his employment on 1st November 2021 for 2 years, his employment contract should end 30th October 2023. Therefore, you need to look at 3 basis periods. 1, YA 2022 that covers 1st November to December 31st, 2021. YA 2023 that covers 1st Jan 2022 to December 31st, 2022. And YA 2024 that covers 1st Jan 2023 to 30th October 2023. So you need to explain under 3-year concessionary rules, Clifford would be treated as a tax resident. Now, thank you for spending the hour with me. I know individual income tax can be daunting and difficult, especially with the various forms of reliefs, but I hope that this webinar will go in a long way to help in your revision and preparation for the upcoming exam. Thank you very much for your time, and I look forward to seeing you again soon if you have the opportunity to listen to the other webinar that I will be covering. Thank you and goodbye.